All right, guys. So we're going to be going over two stocks, two companies that we're going to be selling options on in the future, just because of the big announcements that these companies has had with their 20-for-1 stock splits. And that's going to be both Google as well as Amazon undergoing a 20-for-1 stock split. So if we take a look at our calculator, Amazon stock is right around $2,900 per share. Divided by 20, it's going to be roughly around $145 per share, which is very close to what Apple price is. So why do stocks like this undergo stock splits? There's a variety of reasons, and first one is going to be attracting new investors. A stock split often attracts investors due to the reduction in stock price and lower the barrier to investing. So some brokerages, they don't offer fractional shares, so people who are using those brokerages are able to pick up shares, full shares of these companies, and it's going to be very affordable because it's only going to cost you $100 or so. Second reason is going to be increasing the number of shares. So rather than issuing new shares through a secondary offering, which dilutes the shares, companies can often increase the number of shares by performing a stock split. So remember, the market cap stays the same, but the number of shares increases. So that's why the stock price is getting lower. It also facilitates market activity. Following a stock split, there's often an increase in trading since the number of shares are more affordable. This also leads to overall increases in share price. So investors kind of like to buy in the dip. So when they see stock splits, they think it's at a very affordable price. They end up buying it. It's more attractive to new investors, as we mentioned earlier in point one. And the fourth reason is improving liquidity, because the volume of shares is going to increase. There's going to be more trading activity, and overall, it's going to make the bid-ask spread for buying and selling a lot tighter. So it's going to be easier to buy and share and sell shares. So why is this important? Why do we want Amazon and Google to be roughly around $100 per share? It's mainly for option seller as well. If you have 100 shares of a stock, you could sell covered calls, and that's a really good way to make passive income. And also, Google has two stocks. They have GOOGL as well as GOOG. And the difference is GLOOG Class A, it just gives you voting rights, and then Class C, there's no voting rights involved. It really doesn't matter. As we can see in the past year, it's up 26.42%, and this one's up 26.77% the past year. So it's really the same. The stock price is really the same. I would probably go with GOOG Class C because I don't really care about voting rights. But what I'm really interested in is selling covered calls as well as cash secured puts. Because if you were to sell a cash secured put at the current stock price for, say, March 25th, it's going to cost you six figures. It's going to cost you $260,000 of collateral, as you can see here. That's an insane amount of collateral, and only the really rich people can afford to do that. But once it becomes $145 per share, we can really sell some covered cash your puts on the stock because it's only going to require $14,000 of collateral. And I know it's going to be very attractive to sell options on these stocks. So we're very, very excited for that because Amazon as well as Google are very big companies. They're tech giants and they're very big staples in S&P 500. So that's really what we're looking for, selling puts on both Google as well as Amazon once their stock splits and the stock price is at a cheaper, affordable price. So that's about it for this video. Thanks for watching.